What is golden rule? According to the Oxford Dictionary, golden rule is defined by an important principle that should be followed when doing something in order to be successful. As a futures trader, if you practice these golden rules consistently in your trading, failure is almost impossible, and reaching your dreams and financial goals are just a matter of time. Hi, I'm 𝐷𝐿𝐴. In this video, I'm going to share with you the 8 golden rules for futures traders and how these rules are critically important for you to follow in order to become a successful trader. Click on the subscribe button below and turn on your notification so you don't miss any of the videos we are producing for you in this channel to help you to improve your game as a trader. Rule number 1. Adopt a clear trading plan. Because the emotional stress that is always exists in any speculation situation, and this includes both trading and investing. So you must have a predetermined method of operation, so which includes a set of rules by which you operate and strictly follow. In short, it is your SOP, your standard operating procedure, the rules that you must follow strictly no matter what happens in the market, regardless of a bull market or bear market, whether the market is having low or high volatility, regardless of who runs the government, because trading plan is very important to protecting you from yourself. Why is that so? Well, oftentimes your emotions will tell you to do something totally foreign or negative to what your trading plan should be. And remember this, it is only by following strictly to a trading plan that you have developed for yourself, so you can resist the emotional temptations and all the stress that are consistently present in a speculative situation. Rule number 2. If you are not sure about a trade, don't trade at all. Now, this is very dangerous for a trader to behave. Even for a full-time experienced trader also have this what we so call the itchy hand syndrome. So if you are in a trade and feel unsure of yourself, then you should take your losses immediately or protect your profit with a stop, or at least reduce your position, right? So if you're unsure of a position, you will be easily influenced by many unimportant details or factors that distract you, such as news or even expert opinions that are contrary to each other, and you will probably end up taking a loss. So in short, if you are unsure about a trade, or if a trade which is actually out of your area of competence or out of your expertise, then you should make a conscious decision to choose to do nothing. Alright? Rule number 3. Don't trade too many markets. Now, many beginners traders, when they started to learn how to trade, they trade in almost every market. They trade stocks, they trade futures, forex, and so on. So it is difficult to successfully trade and understand a specific market, and it is almost next to impossible for any individual, especially beginners, to be successful in several markets at the same time. Well, speaking in simple terms, it's like juggling too many balls at the same time for a beginner, and this is very dangerous for beginners, as it can cause you to get distracted easily and get burned very fast, and ultimately you may end up demotivated to trade at all. And we don't have too much time to learn everything we need to know about a market. So in short, put your attention and focus and specialize in just only a few markets. Understand these few markets deeply and comprehensively, better than anyone else, so that you are able to trade confidently and able to profit from these few markets. Rule number 4. Never ever answer a margin call. And this is very important for you to follow. You must never ever add money or top up when you get a margin call. Otherwise, you would lose even more or lose further. And I believe you do not want to get to that negative situation, right? Now, this rule act as a stop loss when your position has already losing money. And if you stick to this rule, you will be forced to get out of the market before disaster sets in, because you are already in the wrong direction and losing money. So what is the logic to add into a losing position, right? And it is often difficult to admit you are wrong and get out of the market, which you probably should have done before you even receive a margin call. Rule number 5. If you can't afford to lose, you can't afford to win. Well, what do I mean by that? You see, losing is a natural part of trading. If you are not in a position to accept losses, either psychologically or financially, then you have no business in trading. This applies to investing in the small stock market as well as investing in running a business. Facing losses is just part and parcel of the process. Trading should be done only with surplus funds, with money that you can afford to lose. This means when you were to face a streak of continuous losing trades, you don't have to worry about your daily living expenses and monthly financial commitments, because losing are just only temporary setbacks, which is the reason why we must focus on the bigger picture, focusing on the long term. When you trade with surplus funds, you won't get so emotional about the fluctuation in the value of your trading account, and you are able to trade with less stress, less distraction, or even worrying too much about what if you lose those surplus funds, right? So remember to only trade with the money you can afford to lose, and acknowledge that losses are just part of trading. Rule number 6. Be aware of the trend. Well, sometimes we say that the trend is your friend. It is critically important for you as a trader to be aware of this strong force in the market, either bullish or bearish. When these forces is at work on its own direction, that's where the excitement comes in. Some people make money, some people lose money. To make money, you must learn to recognize when a trend is about to run its own course or is near a period of exhaustion. With the ability to recognize changes in trend and the early signs of exhaustion, you will be able to protect yourself from staying in the market too long, and you'll also be able to change direction when the trend changes. So unlike the stock market, when you are in the futures market, you can trade both directions, both uptrend and downtrend. When you are able to capture a trend and having a right position, you can have an awesome profit from it. Otherwise, you are in a wrong position. A trend can be your enemy and wipe out your trading capital as well. So remember, the trend can be your best friend and your worst enemy, and you need a trend to make money. Rule number 7. Cut your losses short and let your profits ride. See, the basic failing of most traders is that they put a limit on their profits and no limit on their losses. It's human nature that we hate to admit if we are wrong. So that's the reason why most people often let their losses ride, becoming larger and larger, hoping that eventually one day the market will turn around and prove them correct. Then after a while, they begin hoping for small losses and give up hoping for profit. So if you are wrong in the trade, you will show a loss and you should remove yourself from the situation quickly. Taking a small losses does not necessarily mean you are wrong in your thinking. It simply means that your timing was perhaps incorrect and that you should wait for the correct timing and conditions to allow you to re-enter the market with a better opportunity, better timing. Remember, in any trading situation, The market is the final judge, and we should never ever argue with the market. Let the market tell us when we are wrong and when we are right. So remember this: cut your losses short and let your profits ride. The market is not a place for you to prove whether your thinking or your opinions is right or wrong. Your purpose in the market is to make money. So limit your losses when you are wrong, okay? Rule number 8, never sit on losses. A loss by itself, it's difficult enough to accept, right? Most people only think of locking in profit, but they never think of locking in losses. In fact, locking in losses is a very logical decision rule you must follow in the trading business. You must retain control of the situation and yourself all the time. Do not allow your position to control you, and it is a mistake to find yourself in a position larger than you can reasonably handle. And when this happens, you'll find that the total size of that position rather than the facts of the situation itself affects your judgment. So you should be prepared to treat each day objectively by not allowing emotional fever to carry over or even cloud your judgment. Start afresh each and every day. If you find this video is informative and of value to you, please don't forget to give us a thumbs up and share this video so that others will benefit from this learning as well. And please don't forget to click on the subscribe button and notification bell right now so you won't miss free trading videos that we are posting constantly on our channel to help you to improve your game as a trader. Until next time, this is 𝐆𝐶𝐥𝐿 wishing you good luck and good trading.